Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look the reward. Today, we're diving into Deere Company, DE.
And this is a fascinating one, a massive classic industrial stock that is right in the middle of this incredibly high-stakes technology transformation.
It really is. And when you dig into all the material, the analyst reports, management calls a central conflict just jumps off the page.
It absolutely does. The entire investment thesis is built on this one point of friction.
So what is it?
Deere is betting its smart industrial strategy and this very aggressive goal of hitting about $5 billion in recurring revenue will create a new kind of structural resilience for the company.
The resilience that's supposed to justify its, let's be honest, very high valuation.
Exactly. Justify it despite this massive $1.2 billion projected pre-tax direct tariff expense and a really steep 13% forecasted FY 2026 profit drop that's expected right at the bottom of the cyclical trough.
Okay, let's unpack this because that is an enormous conflict. You have like 3 different stories colliding all at once in fiscal year 2026.
You really do.
You've got a tech story that sounds like it's straight out of Silicon Valley.
Mm-hmm.
Then you have a deep, painful, cyclical downturn in their main business, large ag.
The classic industrial story.
And then on top of all of it, this crushing billion-dollar geopolitical headwind from tariffs.
It is the ultimate stress test.
Yeah.
And what's so interesting in the source material is that management isn't just reacting to this downturn.
Yeah, it seems like they're accelerating into it.
They are. They're basically treating this cyclical trough as the first major real-world test for their whole smart industrial pivot.
So this is an existential shift. They're trying to move from being just an equipment manufacturer.
Right. The gold standard, yes, but still fundamentally cyclical.
To being valued like a high-tech platform, something that generates predictable, high-margin, recurring revenue.
Like a software as a service company almost.
Yeah.
That's the dream, anyway.
Well, that kind of structural change needs hard numbers, not just a good story. So let's start with that recurring revenue goal. $5 billion. How ambitious is that, really?
It's extremely ambitious. The goal is quantified, it's specific. $5 billion in high-margin recurring revenue by 2030.
Okay, so put that in context for us. What does that mean relative to their total sales?
Well, their total sales, they hover around the $50 to $60 billion mark, depending on where we are in the cycle.
So we're talking about
a goal of approximately 10% of total sales coming from these sticky digital services.
Wow. Okay, so this isn't just about selling more parts. This is software subscriptions, data fees.
It's all of that. Software, connectivity fees, and increasingly, these enhanced service contracts you need for the really complex autonomous machines.
Which is a huge bet, because farming is still a volatile business, right? It's driven by commodity prices.
It is, and that's the whole point. This revenue stream is designed to be highly resilient. It's supposed to partially insulate them when the big iron equipment sales inevitably collapse during a bad cycle.
Which is happening right now.
Yeah. This is management's key to changing those long-term cycle dynamics.
Okay, that's the theory. But farmers don't pay for theory. They pay for a return on their investment, and they need it fast.
Right.
If Deere is charging a premium for all this tech, it has to pay for itself immediately. Where's the proof that this is actually delivering real value in the field?
The best, most measurable example is their precision application tech. Specifically, the See and Spray AI-driven system.
The one with the cameras.
The one with the cameras. It's a perfect example of their full-stack advantage. It uses computer vision, machine learning, to tell the difference between a crop and a weed in real time.
So instead of just coating the entire field with chemicals?
Exactly. Instead of that traditional broadcast spraying, this thing only sprays where it sees a weed.
The return on that must be huge.
It's enormous. The data shows it provided average herbicide savings of around 50% in 2025.
50%. I mean, with input costs going through the roof, that is a massive number.
It's a game changer for a farmer's P&L.
But, saving money is one thing. Getting farmers to adopt and trust new technology is another thing entirely. Is the data showing that they're actually using it at scale?
It is. And that's maybe the most compelling data point. They're not just buying it and dabbling.
Those are integrating it.
Yes. We see this great anecdotal proof point in the sources. Customers who bought See and Spray units in previous years, they didn't just use it again.
They used it more.
They scaled it up.
Yeah.
Dramatically. In 2025, they covered, on average, 20% more acres of their land with the system than they did the year before.
Okay, so that says they tried it, they saw the 50% savings hit their bank account, and then they immediately went all in.
That's the story the data tells. The tech works, and customers are voting with their wallets and their acreage.
And there's another point on adoption. The harvest settings automation, right?
Oh yeah, that had a huge take rate. Over 90% on new North American combines in the first year.
Covering 5 million acres.
Over 5 million acres. So the adoption of the broader tech stack is happening very, very quickly.
Okay, so See & Spray tackles the input cost side of the equation, but the other massive threat to farming is labor. Just finding people.
The labor crunch, yeah.
I mean, you can save all the money you want on herbicide, but if you can't get the crop planted or harvested in that critical window, your whole season is a bust.
You've lost everything.
So autonomy has to be the answer to that labor crunch.
It directly addresses the root cause of the crisis. The whole push for true autonomy, a tractor running itself safely with no one in the cab, it's not just about a little bit of efficiency.
It's about survival.
It's about dealing with the acute labor shortage. The sources estimate the U.S. ag industry was short something like 2.4 million workers in 2024.
Wow.
You just can't find people willing to sit in a tractor for 16 hours a day during planting season, especially in remote parts of the country.
So Deere is essentially selling a workforce that doesn't need a break, doesn't need benefits. How does that translate into a hard ROI for the farmer, though?
The value proposition is all about enabling true 204/7 operations.
Maximizing the field window.
Maximizing that field window. In farming, the weather gives you these tight, non-negotiable windows to get work done.
Right.
When you remove the constraint of a human operator who gets tired, who needs breaks, the work gets done precisely when it needs to. You cover more ground in optimal conditions, and that directly improves your yield and your quality.
And they're not just trying to sell brand new multi-million-dollar autonomous tractors to do this. They're being smarter about it.
Much smarter. The retrofit kit strategy is essential for getting this to scale quickly.
So you can upgrade your existing fleet.
Exactly. They introduced tillage autonomy kits that can be retrofitted onto existing 8R and 9R tractors, the ones farmers already own.
That's huge, because now it's not a massive, once-a-decade capital expenditure.
It becomes a high-margin software and hardware upgrade. It dramatically lowers the barrier to entry for farmers who want to try 24/7 autonomy, and it feeds directly back into that recurring revenue model we were talking about.
It all connects. Okay, so if the AI and the autonomous kits are the tools, the digital ecosystem, the John Deere Operations Center, that's the factory floor, right? That's the linchpin that holds it all together.
It's the central nervous system. It's where all the data from every piece of equipment goes to be managed and analyzed.
And the scale is just staggering.
It is. It now covers over 500 million engaged acres globally. That's a footprint that grew 10% just in the last year.
But engaged acres could mean anything. Some people might just be kicking the tires. What about the really committed users, the ones who are all in?
And that's the most bullish data point of all, I think. The number of highly engaged acres.
Which means they're documenting multiple steps, right? Not just looking at a map.
Precisely. They're digitally documenting multiple production steps, actively using the tool to make decisions. That user base grew even faster.
How much faster?
It increased by 17% year over year, up to 147 million acres.
So the most committed users are growing the fastest.
Exactly. And that's vital, because the deeper a farmer gets into that ecosystem, the more historical data they have in the operations center, the higher their switching costs become.
It's the digital lock-in.
It's the ultimate digital lock-in, and that is the real foundation for hitting that $5 billion recurring revenue target. It's a moat that a pure hardware company just cannot build.
Okay, this all sounds fantastic. The technology story is incredibly compelling, but we have to ground this in the reality of today. Let's pivot to the immediate financial drag, the FY 2026 outlook, and the just the crushing weight of these tariffs.
We have to, because the tech story is the long-term reason for the valuation, but the near-term financials are they're extremely tough.
So what's the headline?
The headline is that management has confirmed what everyone suspected. FY 2026 will mark the absolute bottom of the large ag cycle.
The trough.
The trough. The market is shrinking significantly, driven by lower commodity prices, high interest rates, all the usual suspects.
And how bad is the contraction in their core market? North America.
The overall industry forecast for large equipment sales, so U.S. and Canada, is projected to be down 15% to 20% in FY 2026.
That is a massive drop in volume.
It's a huge contraction. Now, Deere expects its core PPA segment production and precision ag to do a little better than the market.
But still down.
Oh yeah, still down. PPA net sales are forecasted to be down 5% to 10%. And even with aggressive cost controls, their margins in that segment are going to get squeezed.
Down to what?
Down to between 11% and 13%.
Which, just for context, that really highlights how severe this is. At the peak, those margins were closer to 20%.
Exactly. It's a big compression.
So let's get to the bottom line number for the whole company. What's the primary guidance for profitability?
The primary guidance for the company's consolidated profitability is an FY 2026 net income forecast of $4.0 billion to $4.75 billion.
And their net income for FY 2025 was $5.0 billion.
That's right. So even if you take the midpoint of that new guidance, you're looking at roughly a 13% year-over-year drop in net income.
It's a big drop. But you're saying that number actually masks some of the operational strength.
It really does, because baked into that forecast is the absolutely devastating impact of trade policy.
Right. The tariff bomb. Let's pull that number out. How big is it and what's getting hit?
It is the single biggest cost hurdle in their entire forecast. The projected pre-tax direct tariff expense for FY 2026 is approximately $1.2 billion.
$1.2 billion. That's a direct hit to income.
A direct, measurable hit. It flows through their cost of goods, sold on components from overseas steel, aluminum, high-tech parts, and also on finished goods from their plants in Europe and India.
And this isn't just a continuation of last year's pain. It's getting worse, isn't it?
It's escalating substantially.
Yeah.
That $1.2 billion figure is an incremental $600 million increase compared to the $600 million expense they saw in FY 2025.
So their tariff burden has doubled in 1 year.
It has doubled. They expect it to run at about $300 million per quarter. Just a constant, predictable drain on profitability.
How on earth do you mitigate a cost increase of that size? I mean, $1.2 billion is almost a quarter of their entire projected net income. They have to be passing that on.
They're trying to. They're leaning very heavily on that technology moat we just talked about to give them pricing power.
So they're raising prices in a down market.
They are. Management says they expect to be price-cost positive for the full year. Specifically, they're looking at list price increases for their North American large ag equipment in the 3% to 4% range for 2026.
That is a huge bet. They're betting the value of the technology is so high that farmers will pay up even when their own incomes are down.
It's very calculated risk, and it's really the only way they can still hit that $4.75 billion floor for net income.
So if PPA is declining and tariffs are eating $1.2 billion, the only way they survive this is through some serious operational defense and structural resilience.
And that is exactly the bull case, that they have fundamentally changed the company and achieved what they call structurally higher performance levels.
Let's look at the proof. What did they deliver in FY 2025, which was already a tough year?
Despite the downturn starting and the tariff impact, equipment operations delivered a 12.6% operating margin in FY 2025.
And why is that 12.6% so important?
Because it establishes a new, much higher floor for their performance during a cyclical trough.
Better than the last downturn.
Way better. That performance is 450 basis points better than what they managed during the previous trough year back in 2016.
450 basis points. So that's what they mean by structurally higher performance.
The definitive proof. It validates all the investment in efficiency and digital operations. It shows the new model can withstand pressure.
What changed? Why are the margins so much better now than in 2016?
It's really a few things. First, the Smart Industrial Plan really did tighten up their operations and supply chain. Second, that small but growing recurring revenue stream provides a little buffer that just didn't exist in 2016.
And the products themselves.
And the products. They've standardized components across platforms, which reduces manufacturing complexity and cost. So even with lower volumes, they can maintain efficiency.
Okay, that's margin protection. But the other classic killer in a downturn is inventory. Having to discount everything just to move it.
Right, and they've been incredibly disciplined there.
What do they do?
In their small ag and turf and construction and forestry segments, they implemented proactive underproduction in 2025.
Meaning they deliberately made fewer machines than people were buying.
Yes. They produced approximately 10% below retail demand all year.
So they let the dealer lots get lean, which prevents a panic later.
Exactly. It creates a production tailwind heading into 2026. Now they can build in line with retail demand instead of having to offer huge discounts to clear out old stock.
And what about the big stuff, the large ag inventory?
They went even leaner there. New field inventory for their big tractors, 220 horsepower, and upended FY 2025 at the lowest unit levels seen in over 17 years in North America.
17 years. That is incredible discipline.
It gives them maximum flexibility and helps them avoid the margin destruction that usually happens in a deep trough.
This brings us to diversification. If PPA, the biggest segment, is getting hammered, the other parts of the business have to step up.
And they are. The diversified growth is a crucial offset. While PPA sales are forecasted down 5 to 10%.
The other two are up.
Both the SAT and CNF segments are projected to see sales up approximately 10% in FY 2026.
A 10% growth rate in those two segments is a huge cushion against the weakness in large ag.
It's a massive cushion.
Let's break down the drivers. For construction and forestry, CNF, what's powering a 10% growth in this interest rate environment?
CNF is benefiting from a few really strong macro tailwinds. They're seeing robust construction backlogs across the industry, rental fleets are investing again, and this is the really interesting one. Surging demand driven by data center construction starts.
Data centers.
All over the world. The overall industry for that kind of equipment is expected to be flat to up 5%, so Deere is positioned to take share and grow faster.
And small ag and turf, what's driving that 10%?
The SAT segment has its own set of drivers. It's getting a lift from healthy dairy and livestock margins, which drives equipment replacement on those SARMs.
Right.
And they're also anticipating a modest recovery in the turf side of the business, which is tied to an expected rebound in the housing market.
So without that combined 10% tailwind from those two segments, the 2026 forecast would look a lot worse.
Far, far worse. The diversification is absolutely critical to the story right now.
Okay. We've laid out the operational strength, the defensive moves. Now we have to talk about the market's view, the valuation, and the competitive moat. Because here's the paradox. We have a company facing a $1.2 billion tariff and a cyclical bottom, but the stock price is just stubbornly high.
This is the core disconnect for investors right now. The stock is trading at a valuation that a lot of people think is completely detached from the near-term reality.
What are the numbers?
The stock trades at a blended PE ratio of 23.5x. Some metrics have it as high as 25.1x.
And its historical averages.
Its 20-year average is 14.4x.
So it's trading at a massive premium to its own history.
A huge premium. And the price to free cash flow is also cited as being very high, around 33x.
So the bear case is simple. Profits are falling 13%. The PE is almost double the average. The stock is just dramatically overvalued.
That's the argument.
So how do the bulls possibly justify a PE premium of nearly 10 points?
It all comes back to the moat. The bulls argue the premium is deserved because you can't value Deere like an old-school industrial anymore. You have to value it as a technology platform.
And that moat is built around the full-stack John Deere Operations Center ecosystem.
That's the heart of it, that vertical integration of hardware, software, and data. Competitors can build a good tractor, but they can't easily replicate that proprietary data pipeline and the AI that runs on top of it.
The technology creates the moat, but what's the physical barrier that keeps the customers inside it?
That's their other huge advantage, the dealer network scale. Deere's dealer network, with over 5,000 dealers globally, is a massive competitive advantage. When you're running a multi-million-dollar autonomous machine 24/7, you need service, and you need it now.
Uptime is everything.
Uptime is everything, and no new competitor can just magically build a service network of that scale. It's a huge barrier to entry.
And all of that technological superiority, it translates into pricing power and profits, which then funds more R&D.
It's a virtuous cycle. Its profitability is moat. These tech solutions provide measurable ROI, like that 0 to 150 cents per bushel improvement for farmers who adopt the full solution.
That creates loyalty.
Fierce loyalty. It gives them the pricing power to push through those 3–4% price hikes, even in a down market. And those profits are what funded the record R&D investment in FY 2025, which keeps them 5 steps ahead of everyone else. That's what the market is pricing in with that high PE.
So this whole deep dive really comes down to a final synthesis, this high-stakes bet. Is Deere just a great cyclical company at a terrible entry price? Or is it a tech platform where the structural changes are permanent enough to override these cyclical forces?
That is the absolute core of the decision. The bulls will point to the future. They see the potential for $34 to $35 in EPS by FY 2027, once the market recovery kicks in.
And they argue that future earnings power plus the tech leadership justifies a strong buy rating today.
They see this downturn as a temporary blip that the company is structurally built to handle better than ever before.
But we have to finish on the risks, the big structural risks that could wreck that whole bull case. It's a battle on two fronts, isn't it? Geopolitical and regulatory.
Two immense risks. First is that massive $1.2 billion tariff risk. It's just an anchor on profitability that is completely outside of their control.
And the second one is maybe even scarier, the regulatory threat.
Regulatory scrutiny. Specifically, the lawsuit filed by the Federal Trade Commission, the FTC, and a bunch of attorneys general regarding right-to-repair policies.
And the right to repair lawsuit could be the single biggest threat to that whole $5 billion recurring revenue goal. Why is it so dangerous to the thesis?
Because Deere's control over diagnostics, parts, and service. That's the linchpin of the digital lock-in. Their proprietary software is the key.
And if they're forced to open that up?
If regulators force Deere to open up its software and data to independent repair shops, it could completely undermine the value of the entire digital ecosystem.
It hits their pricing power, their high-margin parts and service business.
It threatens the whole customer relationship. It threatens the very things that are supposedly justifying that premium PE multiple today.
So, on one hand, you have proven operational resilience. On the other, a billion-dollar tariff and an FTC lawsuit aimed at the heart of your competitive advantage.
It's the perfect summary. The 2026 forecast is a calculated risk. They're managing a painful trough while betting the farm on the technology platform that's supposed to make the next trough less painful.
So here's the final thought for you to take away. Will this recurring revenue stream actually insulate Deere from future cycles? Or will the $1.2 billion tariff and the regulatory scrutiny prove that even a dominant tech player can't escape geopolitics and macro pressure?
That's the question. The whole thesis rests on their tech leadership surviving this current financial pressure cooker. If you believe they hit $34, $35 in EPS by 2027, today's price is probably fine.
But if you think the tariffs and the regulatory risk are permanent problem,
then that premium valuation looks incredibly unstable, and the cyclical pain has not been fully priced in yet.
a fascinating and complex picture. Thank you for walking us through it.
My pleasure.
Risk defined, portfolio protected.